Before we explore inventory accounting, let's set up a few prerequisites that will help us understand it better. First, we need to activate perpetual inventory. We can do this by navigating to the stock settings in our company master. Here, we can see the Enable Perpetual Inventory checkbox. It is selected by default. If we disable perpetual inventory, we will have to manage account entries manually. Next, let's set up some default accounts for our company. These accounts are created automatically in a new ERP next system, that is, the default inventory account, stock received but not billed, stock adjustment account, and expenses included in valuation. If we want to set individual accounts for each warehouse, we can create an account head for each account. To do this, we can navigate to the chart of accounts and create a new account with the same name as the warehouse under stock assets. Now, we can open the warehouse master for any particular warehouse and tag the appropriate account we just created here. This helps us filter and view statements warehouse-wise. Next, we need to set up a valuation method in stock settings. We can see this setting in the item default section. By default, the valuation method is set to FIFO, which is first in, first out. If we select moving average, all new items will be valuated at moving average. We can change the valuation method while creating new items, but once an item is saved, we can't change its valuation method. Let's see how perpetual inventory works while creating a purchase receipt. Perpetual inventory will make it easier for us to maintain the accuracy of the company's assets and expense value. Stock balances and relevant account balances will be synced so that we won't need to add periodic manual entries to balance them. Here's an example. Suppose we have purchased 10 pieces of this item at 1,200 each from a supplier. Let's make a purchase receipt for this transaction. Once we've added all the details, we can save and submit it. We can go to the stock ledger and see that the stock balance increases because of this purchase receipt. The store account is debited and a temporary account, stock received but not billed, is credited to maintain a double entry accounting system. When we receive a bill from the supplier for purchase receipt we just created, we will need to make a purchase invoice for it. Let's make one directly from the purchase receipt. Once we do that, we can open the general ledger and see the entries. The stock received but not billed account is debited, which nullifies the effect of the purchase receipt. Now, let's create a delivery note. Suppose we have to deliver 5 chairs to a customer at 1,500 each. Let's add these details to the delivery note and save and permanently submit it once done. When we open the stock ledger and general ledger, we can see the following entries. As an item is delivered from store's warehouse, store's account is credited and an equal amount is debited to the expense, which is cost of goods sold. The debit or credit amount is equal to the total valuation amount of the sold items. The valuation amount is calculated based on your preferred valuation method, that is FIFO or moving average, or actual cost of serialized items. In this example, the valuation method is FIFO. In the case that we didn't make a delivery note against the order we created, instead we made a sales invoice directly, let's create one and add the same details as we did before. We will also need to select the Update Stock checkbox. Once we've added all the details we can save and submit this sales invoice. Let's see the stock and the general ledger. Here, we can see that apart from the normal account entries for an invoice, stores and cost of goods sold accounts are also affected based on the valuation amount. Let's move on to an example for material receipt as well. Suppose we received 50 pieces of chairs that is going to the store's warehouse. The rate for each chair is 220, so the total amount is 11,000. Once we make this material receipt, we can open the stock and accounting ledger. In the stock ledger, we can see that the stock has been added to the store's warehouse along with its valuation rate. In the general ledger, we can see that the stock adjustment account has been credited and the stock in hand account has been debited. Let us create a material issue. Once we create it, we can have a look at the stock and accounting ledgers. Here, we can see that the transaction is shown as an out transaction in the stock ledger. And in the general ledger, we can see that the cost of goods sold account is debited and the stock in hand account is credited. Now, let's see about material transfers. Let's see a material transfer whose status is still work in progress. If we want to see this transaction in the stock ledger, we can see the store's warehouse is debited and the work in progress warehouse is credited.